A year ago, Meta was struggling due to Apple privacy changes, which sent the stock crashing 75%. But fast forward to today, Meta is up 150% year to date and is almost back to its all-time highs. And recently, the company posted blowout Q2 earnings results, which saw the stock making another 52-week high. In other words, the comeback is real and the turnaround is complete. My name is Riyado and this channel is all about finding the companies of tomorrow, and in today's video, I'll be going through Meta's Q2 earnings results and discuss the valuation of the company given its recent rally. And full disclosure, I do have a position in Meta, so I'll be talking about what I'll be doing with the stock. With that said, let's get on with the video. So in Q2, Meta beat analyst expectations on both earnings per share and revenue by 7 cents and $1 billion respectively. After posting 3 consecutive quarters of revenue declines in 2022, Meta is back to growth mode with revenue accelerating by 11% year over year, generating $32 billion of revenue in Q2. And the return to growth was due to easier year-over-year comps as well as a strong recovery in global advertising demand, but overall, it's really great to see that revenue is picking up again. So Meta generates most of its revenue from advertising, and as you can see, advertising revenue from its family of apps was struggling in the better part of 2022 due to the Apple iOS privacy changes, competition from other social media platforms like TikTok, as well as the rapid growth of Reels, which pretty much shifted users' attention from higher monetized services like feeds or stories. However, things are getting better with FOA revenue accelerating back to growth mode, and in Q2, FOA revenue was $31.7 billion, which is up 12% year over year due to strong demand in the e-commerce sector. In Q2, ad impressions increased by 34% year over year, while the average price per ad decreased by 16% year over year. The increase in ad impressions was driven by rapid growth in less mature markets as well as Reels, which both have lower monetization, which is why the average price per ad dropped year over year. That said, I do expect monetization to improve with each passing quarter. This is especially true for Reels, which has an annual revenue run rate exceeding $10 billion, which is up from $3 billion last fall. In other words, Reels engagement and monetization is growing exponentially. As a reference, TikTok generated $9.9 billion of revenue in 2022 and is expected to grow to $22 billion by 2025, so I think we can expect the same kind of trajectory for Reels, which is going to be a major revenue contributor for Meta. Family monthly active people, which includes Facebook, Instagram, WhatsApp, and Messenger, grew by 6% year over year to 3.88 billion in Q2, which really destroys the narrative that Meta is a slowing and dying social media giant. So to give you a little bit of perspective, a 6% year over year growth rate is about 230 million users added into the platform, which is about 2/3 of the US population. So let that sink in. In addition, daily active people as a percentage of monthly active people remains at 79%, which shows really high engagement rates across Meta's family of apps. And as you can see here, Meta keeps on adding more users into its platform despite the challenging microenvironment that we're seeing today. Here you can see how family average revenue per person has trended over the last few quarters, and in Q2, ARPP was $8.32, which is up 5% year over year due to better ad supply and demand dynamics, as well as Reels monetization picking up. Facebook monthly active users, which only includes figures from Facebook, grew by 3% year over year in Q2 to slightly more than 3 billion Facebook users, which again destroys the narrative that Facebook is dead. Facebook average revenue per user or ARPU is also accelerating, with worldwide ARPU at about $10.63, which is up 8% year over year, driven by strength across all regions. As you can see, there's still a large variance in ARPU when we look at them by geography, and I still see a massive opportunity for Meta to increase monetization in regions outside of North America, since there's so much more people outside the region. That said, it's still encouraging to see all regions improving monetization. Moving on to Reality Labs, the RL segment generated $276 million of revenue in Q2, which is down 39% year over year, which is quite concerning given that the company has invested tons of money into the metaverse. And here you can see that it has been negative growth over the last 4 quarters for Meta, which is very concerning. A major reason why Reality Labs sales are down is due to the recently launched Sony PlayStation PlayStation VR 2, which is Sony's successor to its 2016 PlayStation VR headset. As you can see, Sony took a massive market share away from Meta, which saw Meta's market share decline to just 49% in Q1. That said, the metaverse is still in its early stages, so Meta's RL revenue will be quite volatile, but moving forward, VR and metaverse adoption should continue to grow, which should be a tailwind for Meta's RL segment. All in all, Meta's return to growth mode is really encouraging to see. In particular, growth in its social media business is re-accelerating, which is an incredible turnaround given the challenges that Meta faced over the last few years, including the Apple privacy changes as well as a slowing global advertising demand. At the same time, the company is investing heavily into AI, which is already improving overall user engagement as well as monetization as seen from Q2 results. And not forgetting to mention, the company is still laser focused to develop the next generation social media platform through the metaverse. So all in all, a really great quarter for Meta. Turning to the profitability of the company, Meta generated $26.1 billion of gross profit, which is an 81% gross margin. As you can see, gross margins has been improving over the last few quarters and is now back to its prior levels of about 80%. And maintaining such high gross margins means strong pricing power, strong demand for its products, and high earnings potential for investors. Operating profit is also improving, which was $9.4 billion in Q2, which is a 29% operating margin. Now, this includes accrued legal expenses of $1.87 billion and restructuring charges of $780 million. So without these expenses, operating margins would have been much higher. That said, margins are trending in the right direction primarily due to layoffs, and as of the end of Q2, Meta has about 71,000 employees, which is down 7% sequentially from Q1. And I think Meta is almost done with its layoffs, so we could see margins continue to improve and eventually stabilize in the mid-30s as the year of efficiency resumes. And if not for Reality Labs segment, operating margins would have been as high as 40%. As you can see, Family of Apps operating margins was 41% in Q2, and it was also as high as 50% a few years ago. On the other hand, the Reality Labs segment is severely unprofitable, burning about $4 billion per quarter, and as of Q2, the RL segment has an operating margin of less than 1,000%. But fortunately, Meta has the Family of Apps business to cover up the losses from Reality Labs, and this is going to be the case moving forward, at least for the next 3 years or so. Finally, Meta's bottom line is also improving with $7.8 billion of net income in Q2, which represents a 24% net income margin, and this should continue to trend upwards, most likely to the mid-30s level. But I gotta say, this is probably one of the best turnaround stories ever. Just look at revenue and margins last year. They were awful, and Zuck was able to completely turn around the company within a few quarters, which is just incredible. And I think the markets are just surprised with how fast the company turned around, which is why the stock is up so much year to date. And there's a clear trend that profitability will return to where it was, and this should eliminate all fears about the company's profitability. That said, Meta is a highly profitable business with high earnings potential, and as a shareholder, I'm very happy with how well management has executed so far. Moving on, Meta has a strong balance sheet with $53.4 billion of cash and short-term investments, with a total debt of $36.2 billion, which puts its net cash position at a comfortable $17.2 billion. And although net cash has dropped over the years, I think we can see net cash building back up as the company focuses on efficiency. And that is possible through strong free cash flow generation, and in Q2, the company generated free cash flow of $11.1 billion, which represents a free cash flow margin of about 35%. While free cash flow improved significantly, do note that this is due to a deferral of income taxes that will be paid in the fourth quarter, so I think free cash flow is going to dip slightly in the next few quarters. That said, Meta repurchased almost $800 million of its stock in Q2, which is tiny compared to previous quarters, but this is reasonable given the recent rally. Nonetheless, Meta still has $40.9 billion of share buyback capacity at its disposal, so I expect aggressive buybacks if we see a correction in the near future. In terms of outlook, management provided the following guidance. So management expects Q3 total revenue to be in the range of $32 to $34.5 billion, which represents a 20% year-over-year growth if we take the midpoint guidance. And this is an acceleration from Q1's 11% growth, and this is due to a foreign currency tailwind of approximately 3%, easy year-over-year comps, as well as increasing monetization across its apps. That said, a 20% growth in Q3 is really impressive, which is also why the stock is up after Q2 earnings. As for expenses, management expects full year 2023 total expenses to be in the range of $88 to $91 billion, which is an increase from its prior range of $86 to $90 billion, and this is due to legal related expenses as well as a $4 billion restructuring cost. The company also expects Reality Labs operating losses to increase year over year in 2023 as the company continues to invest in AI and the metaverse. In other news, paid messaging is also taking off, which could be Meta's next growth engine. According to Mark Zuckerberg, there are 200 million users using WhatsApp Business who will now be able to create click-to-WhatsApp ads, and the number of businesses using its paid messaging products has doubled year over year. So this is a really exciting development given that WhatsApp runs a virtual monopoly in some markets, particularly those in developing countries like Indonesia and Brazil. That aside, digital ad spending worldwide is expected to continue to grow as the world becomes increasingly digital, with that figure expanding to $870 billion by 2027. So naturally, this should be a tailwind for Meta as the company holds some of the most valuable digital platforms in the world, including Facebook, Instagram, and WhatsApp. Speaking of which, Meta recently introduced the Twitter copy Threads, which could also be a major growth engine for Meta one day. It is by far the fastest growing platform today with 100 million signups in just 5 days, and the second fastest app to reach 100 million users was ChatGPT, which took 2 months to get to that figure. I don't think Threads is currently monetized, but that is the monetization strategy that Meta usually takes. First, they try to get as much signups as possible. Second, they try to drive as much engagement and retention within the platform. And finally, once the platform scales, Threads can begin monetization. And the company ran this playbook with Instagram, Reels, and WhatsApp, and Threads will be no different. What's the revenue potential, you may ask? Well, Twitter did about $4.4 billion of revenue in 2022 alone, with about 360 million users. That said, I have no doubt that Threads will surpass Twitter in terms of number of users, and Threads could potentially deliver that kind of revenue numbers if Threads actually become a real thing that people actually use, rather than a one-time sign-up. In addition, Meta is expected to launch its updated Quest 3 headset this fall, which I think a lot of consumers are waiting for, so I think we can expect Reality Labs revenue to ramp up in Q3 and Q4. With that being said, I think there's a lot of exciting developments happening in Meta, and I think the outlook for the company is looking really great. Turning to valuation, we can see that Meta has rallied more than 250% ever since its bottom in November, so that's a lot of gains in less than a year. As for me, I have a position in Meta at a cost basis of $135 per share, and I was buying when others were panic selling back when things seems to get worse and worse for the company. But I felt that the issues that the company was facing was temporary, and fundamentally, the company has a resilient business model with strong competitive advantages, and the company was also buying back its shares very aggressively, which is why I also bought the stock. And 3 months ago, I uploaded a video on Meta's stock arguing that the stock is still undervalued despite the Q1 earnings pop. And fortunately for me, I held on to my shares and the stock rallied another 30% since my last video. But the question is, after a 250% rally, is Meta stock still worth investing at current prices? Let's take a look. Looking at its valuation multiples, we can see that Meta trades at an EV to revenue multiple of just 6.36 times, which is well below its 10-year average of about 10 times. So statistically speaking, Meta still looks cheap. But things looks expensive when we look at its PE ratio and price to free cash flow ratio. As you can see, both metrics are trading at the upper end of their 5-year ranges with a PE ratio of about 38 times and a price to free cash flow ratio of about 36 times, so definitely not cheap at all. So from a valuation multiple perspective, I don't think there's much value for Meta stock today. But if we look at what analysts think think, we can see that Wall Street is very bullish on the company with 34 strong buys, 8 holds, and just 1 strong sell recommendation. The average price target is about $348 with a street high of $435 and a street low of $100, which represents an upside of 7% from the current price of about $325 a share. In my previous video, I did a DCF analysis on Meta as well, and today I want to give you an update on my model. The main change that I did was I raised my revenue estimates, and for the first 3 years, I will follow analyst estimates on revenue growth and then gradually decrease it to just 7% by the end of 2032. Next, I expect cost of revenue to drop as a percentage of revenue to just 17% by 2032, which means a long-term gross margin of 83% for Meta. I expect the same thing for operating expenses, which will continue to decrease as a percentage of revenue down to just 40% of revenue by 2032, which Meta has achieved before in prior years, as you can see right here. So combined together, cost of revenue and operating expenses in 2023 will be about $90 billion, which is right in line with management's guidance. Income tax and depreciation and amortization will be set at a constant rate of 20% and 7% respectively. Next, stock-based compensation will eventually stabilize to just 6% of revenue. And as for capex, the company guided for $27 to $30 billion in 2023, so that is about 22% of revenue, and then I'm going to decrease that percentages to just 15% of revenue by 2032. And finally, changes in net working capital will be set at a constant rate of negative 2.2%, which is its 5-year average. So with these assumptions, I project a $280 billion revenue by 2032 at a free cash flow margin of about 30%, which is reasonable in my opinion. And based on a discount rate of 10% and a perpetual growth rate of 2.5%, I arrive at an intrinsic value per share of about $302 for Meta, which is lower than the average analyst price target of $348. My new fair value estimate is also $30 more than my previous estimate, but despite the upward revision, Meta looks slightly overvalued based on its current price of $325. And if I were to exclude share-based compensation in my calculation, my fair value estimate will drop to $233, which means Meta looks even more overvalued. But what am I doing with the stock? Probably nothing for now, but if prices continue to rally in the next few months, I might trim my position at about $363, which is about 20% above my fair value estimate. Now let's quickly go through the major risks in investing in Meta. First and foremost, we have competition. There's other platforms such as TikTok, Twitter, and YouTube that could take market share away from Meta. However, as we've seen in Q2 results, Meta continues to add users into its family of apps, which means that Meta's brand is just too strong and its switching costs are just too high for users. Nonetheless, threats of competition are real and we can't totally ignore them. A potential threat for Meta will be Twitter, which recently rebranded to X, and the reason for the rebranding is that Elon Musk wanted to build an everything app, much like WeChat in China. If that happens, Meta could be in big trouble, so keep that in mind. On the other side, Reality Labs is also facing tough competition from Sony and Apple. Sony's PlayStation has a huge library of games, and die-hard PlayStation fans are more likely to invest in Sony's VR headset than Meta Quest. In addition, Apple launched its own headset called the Apple Vision Pro, and even though the price is too ridiculous for mass adoption, we all know that Apple fans are not too price sensitive when it comes to Apple products. So again, competition is real and investors should not underestimate them. Next is policy changes, and this includes policy changes within Apple iOS or Android and even government regulations affecting Meta. And if we see major changes in policies and regulations, Meta could take a big hit once again. To wrap up this video, I think Zuck is just incredible. Execution is phenomenal, and as an investor, I couldn't be any happier. The company is back in growth mode, margins are improving, the balance sheet is pristine, and there's so many exciting developments in the horizon, including Threads, Meta Quest 3, Click to WhatsApp, and so on. So there's a lot to like about Meta, which is why the stock is up so much. And that is one thing that I don't like about Meta stock. It's valuation. I think the rally has gone a little bit too far and valuation is a little bit stretched at the moment, which is why I'm doing nothing with my current holdings. But if the stock continues to rally above $360, I might take profits. With that being said, what do you think about Meta stock? Please let me know in the comment section down below. Otherwise, that's all that I have for you today. As always, thank you for watching this video. I appreciate you and I hope you have an amazing day. Thank you, and I'll see you guys on the next one.